Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Welcome. Today we're reviewing the J.P. Morgan APAC Consumer and Internet Specialist Commentary. This was published on January 9th, 2026.
Right, and it gives us three key updates: a preview of Alibaba's third quarter, a look at fast retailing's first quarter results, and then the outlook for Taiwan's textile and footwear ODMs.
Exactly. So our objective today is to really get into the research logic for each of these and pinpoint where the arguments are most fragile.
It's a challenging synthesis. You've got an AI transition, a retail recovery, and a cyclical rebound all in one node.
It is. So let's start with Alibaba. The context here is just a spectacular conflict.
The divergence thesis, yeah.
J.P. Morgan's analyst Alex Yao is cutting future earnings per share, FY27 and 28, by quite a bit.
Citing the heavy AI investment and, the weak domestic e-commerce picture.
A really weak picture. They're forecasting customer management revenue, CMR, growth at just 1% for the December quarter.
1%. And yet, the stock jumped.
It jumped over 5% overnight, just on the news that the NVIDIA H200 AI chip was approved for export to China.
So you have investors anchored on near-term earnings selling, while long-term tech investors are buying the AI story.
That's the battleground, and it's a huge bet, right? Alibaba is modeled to widen its losses in that all other segment.
That's where all the consumer-facing AI apps sit, like Xuan and Quark.
Correct. They're modeling that loss to hit 9 billion RMB in the March quarter alone.
So the core question the analyst is trying to answer is basically, when does this cash burn start paying off?
Exactly. When does this massive strategic spend translate into better unit economics and cloud growth that's big enough to offset these huge profit cuts?
It's all about finding that inflection point.
And the bullish assumptions are, well, they're tempting. The whole thesis rests on cloud revenue growth continuing to accelerate.
Moving from, 34% up to over 40% by mid-2026?
That's the trajectory, and all while keeping EBITDA margin stable, around 8%. That 9 billion RMB loss is just framed as a temporary cost of acquiring those Gen AI users.
Okay, that's laid out pretty clearly. But I wonder if the fragility point is how those two pieces interact: the e-commerce weakness and the AI spend.
I think that's exactly it. The core weakness is that the analysis kind of separates the operational drag of domestic commerce from the strategic investment needed for AI.
Right. The analyst sees the soft consumer backdrop, hence the 1% to 2% CMR growth forecast. But the linkage?
The linkage isn't just about weak revenue. It's about the ability to fund the AI pivot at all. Think of the domestic commerce segment as the cash tap.
And the JPM thesis says that tap is barely dripping.
Barely. So the flaw is, if that drip slows down even more, that's where the 9 billion for AI is coming from. If competition gets worse or the consumer weakens further,
then the financial capacity to make that AI pivot it evaporates.
It evaporates instantly. So the analysis really needs to explicitly model a stress test scenario.
A stress test that ties the e-commerce downside directly to the cloud and AI timeline.
Exactly. Right now, they're treated as two separate things. Cloud is the upside, e-commerce is the risk. We need to see if the whole thesis holds up when you connect them under financial strain.
So what would that look like in practice? A concrete example.
Okay, so the analyst could model a scenario where domestic CMR goes completely flat, or even negative.
And that forces them to pour more money back into e-commerce just to hold share.
Precisely. Let's say an extra 5 billion RMB in subsidies or logistics. The report then needs to show how quickly that 5 billion eats into the projected cloud EBITDA stability.
And what new metrics would justify the valuation then?
That's the key. What's the new trigger point for the long-term bulls if the e-commerce engine stalls? Without that calculation, this divergence thesis is just an interesting concept. It's not financially stress-tested.
That's a crucial refinement. Okay, let's move on to fast retailing.
Right. The theme here is the overseas sustainability question. First quarter results were a huge positive surprise.
Operating profit overshot consensus by over 30 billion yen.
And 90% of that beat came from overseas Uniqlo, mostly Greater China.
Which really defied the market's skepticism, given the sluggish Japanese retail scene and the doubts about China's recovery.
So the core question the analyst Murata-san is asking is this strength sustainable? Is it structural improvement, or was it just, good weather?
Favorable seasonal tailwinds?
Yeah. Management is pointing to strategic shifts. They're focusing on brand building instead of just handing out coupons. The scrap and build store optimization and that new JD.com collaboration they started in September. And they're citing OPM expansion from better marketing and discount control.
Which all makes sense. But the evidence feels a little circumstantial, doesn't it? Management themselves admitted weather played a role.
It did. And that immediately makes the whole "it's all structural change" argument feel a bit fragile.
Investors need more than just a good story to project a 30 billion yen beat forward. I feel like the lack of hard, non-financial metrics is a real vulnerability here.
I agree. To really solidify this view, the report needs to move beyond these general structural improvements and define some measurable, non-financial proxies for this strategy shift.
Because just relying on the management narrative leaves the thesis exposed. OPM is a lagging indicator.
Right. If OPM drops in the second quarter, you've already missed the turn. We need proof that the operational machine is actually different now.
So the suggestion is to track leading indicators instead of waiting for the financial results. What specific metrics would do that?
Okay, so, for example, instead of just OPM, track the change in average selling price, ASP, by region, especially in Greater China.
Because a sustained rise in ASP would be direct proof that they're shifting away from coupons to real brand value.
Exactly. If people are paying more per item, that's structural. That's brand power.
Okay, what else?
Another one would be to track the four-wall profitability of only the new flagship stores. Isolate them from the legacy fleet. That tells you if the scrap and build location strategy is actually financially superior.
Filters out the noise. I like that.
And finally, quantify the contribution from the JD.com partnership. If that channel is driving higher margin, full-price sales, that's not just a transient bump. That's a structural improvement.
Right. That turns a qualitative story into a quantitative framework. Very strong.
Okay, let's pivot to the final section. The Taiwan ODMs, the textile and footwear suppliers.
The selective cyclical comeback thesis?
This is really a valuation play at its heart. The whole sector got beaten down. It's trading at or below its 5-year average PE. So there's an attractive risk-reward profile here for 2026.
And the conviction is pretty clear, with the double upgrade of Makalat to overweight.
It is. So the core question from the analyst, Bill Lin, is which of these ODMs are actually best positioned for the upturn, and are the margin drivers strong enough to support a re-rating?
Things like lower tariff costs and better factory utilization.
Right. The assumptions for the comeback are very specific. You've got tailwinds from the FIFA World Cup projects, crucial restocking from big customers like Gap, Target, and fast retail,
and the richer product mix. Lai Yi, focusing on niche, high-growth stuff like Samba and pickleball shoes for Adidas and Hoka.
And critically, Makalat and Eklot already have 6 months of order visibility for the first half of 2026.
So the analysis is very focused on stock picking. It's not a broad buy-the-sector call.
Not at all. And that specificity is both its strength and its biggest sensitivity. The analyst keeps an underweight rating on Fengte,
the big Nike ODM.
Right, citing weak Nike orders that are expected to continue into 2026. It really highlights that if you pick the wrong horse, the cyclical recovery won't save you.
So the fragility isn't the macro cycle, it's the micro risk, high customer and product concentration.
Exactly. The selective nature of the thesis, while smart, introduces this unmitigated concentration risk that really needs to be quantified.
That's a great point. How is that risk being addressed right now, or is it not?
Well, for a company like Lai Yi, the growth forecast for the second half of 2026 is hyper-dependent on two things: expanding capacity for Adidas and the market traction of new Hoka products.
Which basically turns a stock into a leveraged derivative play on a few specific shoe models. That's a massive single point of failure risk.
It is. If Hoka's new line doesn't hit, Lai Yi's entire second half thesis could just stall, and that has nothing to do with the overall global footwear market.
Correct. So the suggestion is
to provide some kind of contingency metrics against this micro-level product risk.
Yes, to help investors hedge against a specific customer risk that's totally uncorrelated with the broader cycle.
This is the difference between picking a strong sector and picking a strong stock. The risk profile is completely different.
And to make that actionable, you have to provide the math. So for Macalot, for instance, the analysis should model what happens if a key client like Gap, say, destocks.
What's the impact if that 35% of revenue takes a hit?
Exactly. And for Lai, it needs to be even more precise. If 40% of their second half growth depends on new Hoka models, then model a 50% downside scenario for that single product line.
And show the direct impact on EPS. That allows investors to properly size their position, understanding the intrinsic risk.
Right. It moves the analysis from just an insightful prediction to sophisticated risk management.
That's a great way to put it. So that brings us to the conclusion.
It does. We've looked at the JP Morgan research structure across these three very different themes.
And the overarching theme really across all three is the need to find and quantify structural proof to justify going against the consensus noise.
Right. For Alibaba, it means stress testing how e-commerce weakness directly impacts the AI investment buffer. Make the math transparent.
For fast retailing, it's about shifting from the management narrative to tracking hard metrics like ASP or new store profitability to prove the changes are real and not just weather.
And finally, for the Taiwan ODMs, the action is to model the extreme risks that come with high customer concentration.
So investors aren't blindsided if one key product launch or a major customer shifts strategy.
It's all about isolating those structural improvements to justify the investment case. We encourage our listeners to keep challenging their own analytical frameworks.
And we look forward to seeing the next stage of your work.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.